Hi everybody, it's Peter Schiff. This is Friday, September 24th, 2010. Well, the Dow was up 200 points today. It closed at its highest level since May. Unfortunately, the dollar dropped about 1%. The dollar index closing at its lowest level since January. The dollar index closed at 79.30, I believe. That's 11% lower than it was 3 months ago when it hit its peak. Now, I think the technicals are now so weak for the dollar that I think the dollar index is going to drop down to about 75 before the end of the month of October. I think by next year, the dollar index is going to take out the low of around 70 even that we set in 2008. And below that, I think the dollar is a bottomless pit. Now, the flip side of the dollar, look at gold. Gold hit a new record high today. I think spot closed just over 1270. The December futures contract got above 1300 for the first time ever. Silver prices hit a 30-year high today, $21 an ounce. We finally took out the high from March of 2008. And again, a lot of talk on the television shows, financial shows, precious metals bubble, precious metals bubble. Look at the gold mining stocks. I mean, they barely moved today. In fact, if you look at the HUI index, the HUI, it's still lower than it was in March of 2008 when gold was only $1,000 an ounce. So you've had a 30% move up in gold. You've had no move in the gold stocks. Sure, there are individual stocks that have made new highs, but the index has not. And, that's where the real speculative money flows. It goes into the gold mining stocks. That's where all the leverage is. How can it be a bubble when there's no speculative money flowing into the mining stocks? We are not even close to a precious metals bubble. If you still want to see a good article I wrote in 2006, when they were all talking about a precious metals bubble, when gold finally hit about $600 an ounce. It's more than twice that price now. But if you go to the archives on Europac.net for my commentaries and search the keyword bubble, you'll read my article, top 10 signs of a precious metals bubble. We still haven't had any of those signs yet. So we are nowhere near a precious metals bubble as far as I'm concerned. Now, also, I want to talk about, we found out just after I recorded my last video blog that President Obama's advisor, Larry Summers, is resigning. I guess he's done enough damage in Washington, so he's going back to pollute the minds of our kids over at Harvard. And I happen to be watching on CNBC, and Mark Haynes and Aaron Burnett were discussing who his replacement should be. And Aaron Burnett said, well, I wonder if there's any dark horse candidates that might get nominated. And then Mark Haynes said, how about if they nominate Peter Schiff? Which, I happen to be listening. And then, immediately Aaron Burnett says, well, Mark, I asked for a dark horse, not a dead horse. She then, of course, apologized to me, but I thought it was nice to have my name out there. And I thought, I wish I was a guest at the time, and somebody asked me who I thought should replace Larry Summers. Because, of course, my first answer would be, nobody. Why does the president need economic advisors? Let's fire all those advisors. We didn't even have a Department of Economic Advisors until the Second World War. The country did great prior to then, so let's get rid of all these advisors. We need to cut government spending. Let's stop with eliminating economic advisors. But if we really need to have one, I thought, well, why not a parrot? You could buy a parrot and, feed him crackers. You don't need to pay him. We can save some money. And then Larry Summers can teach the parrot everything he knows about economics, which shouldn't take long. And then when Barack Obama wants to know what to do, he can pull out the parrot, he can ask for some economic advice, and the parrot could say, print money, which basically is all Larry Summers knows, because all of his economic suggestions all boil down to one thing, print money. And we don't need, an economic advisor. Any parrot can say print money. So that's my nomination for to replace Larry Summers. Also, I want to talk a little bit again about Barack Obama's town hall meeting he gave on CNBC. I mentioned it again in depth on my radio show on Wednesday. But one thing I wanted to talk about again in a little bit more depth, I thought it was very telling about Barack Obama, is early in the show, he talked about the colonies and the Revolutionary War. And he said that Americans, we had a revolution against the British because the British were oppressing us without representation. Oppressing us without representation. That means that President Obama thinks it's okay when governments oppress their people as long as they have representation, which is exactly what he's doing right now, which is why he thinks it's okay. He thinks it's okay to oppress us as long as we can vote for the oppressor. Well, what our founding fathers were revolting against was taxation without representation. They didn't want to be oppressed, even if they could vote for their oppressors. It's unfortunate that Barack Obama doesn't know that, but it really does a lot to explain, his way of thinking and why he does what he does. Now, also, I want to talk again about this Fed's new mandate to create inflation. The Fed is no longer trying to promote price stability by its own admission. It thinks price stability is a problem that it's going to solve by creating inflation. But what is the real reason that the Fed thinks we need more inflation? It thinks we need inflation to create jobs, to fight high unemployment. Well, how does that create jobs? How does making the cost of living go up create jobs? Well, here's the Fed's thinking. The Fed thinks that they can create enough inflation and prices rise, but wages stay the same, then the real value of wages will come down, making labor less expensive. And if labor becomes cheaper, then businesses will hire more people. It's basic supply and demand. As price goes down, demand goes up. But what the Fed doesn't understand is that the wages, that's only part of the cost of hiring people. Another part is regulation. Another part is taxes. And all that is going up. So even as inflation is bringing labor costs down, taxes and regulation are pushing them up. So no jobs are going to be created. In the meantime, you need capital to create jobs, and the government is destroying capital. So we're not going to get any jobs. All we're going to get is inflation. All we're going to get is rising prices. There is no benefit from what the Fed is doing, but you have to understand the problems that the Fed is creating in the process. Now, of course, most people don't understand these problems. I was watching on CNBC today, and they interviewed this guy, I think David Tepper, who's a billionaire who manages a successful hedge fund. So the guy is a very wealthy guy, made a ton of money, obviously is a good trader, doesn't know a thing about economics. I mean, basically what he told CNBC was that, well, he said the economy is either going to get better on its own or the Fed's going to get in and make it get better. Well, as if the Fed could just will the economy to improve, as if they could just print money and magically make everything better. But this is what this guy actually believed. And when he was talking to the interviewers on CNBC, the way he feels the Fed will create economic growth is to create consumer spending. And the way he's going to do that is buy up mortgages with quantitative easing so that people who have mortgages at 5% can refinance them all the way down to 1%. And what he said was, well, if everybody can refinance their mortgage from 5% to 1%, they're going to have all this extra money, they'll run out and spend it, and then presto, we have economic growth. Well, you know what? If the Fed printed enough money to buy up all the mortgages so that rates actually fell to 1%, he's right. We would be spending a lot more money. The problem is we'd be spending it all on food. You see, we'd be spending more money, but we wouldn't be buying any more stuff. All that would happen is we'd have to pay a lot more money for the things that we did buy. And of course, there'd be a lot less to buy because there'd be nothing on the shelves. But the point is, you've got a very intelligent, wealthy, successful investor who is completely clueless about economics. So imagine how everybody else feels. I mean, this is what's out there. It is widespread ignorance. People assume that what the Fed is doing is going to work. Now they're calling it QE2, quantitative easing 2. But you know what? It ain't going to work any better than QE1 or all the Qs. And whether they do a QE3 or a QE4 or QE5, none of it is going to work. Again, it's the basic definition of insanity, repeating the same thing over and over again and expecting a different result. See, the problem is we're trying to reflate a bubble. You can't do that. We're trying to rebuild the house of cards economy that just collapsed. Well, it can't be rebuilt. And apart from it being a house of cards, there's no foundation anymore. I mean, you can't build an economy without a foundation. It'll keep collapsing. In order to have a real foundation, it has to be built on savings, on underconsumption, on capital investment, on production. But none of that is happening. We're trying to recreate it based on debt and consumption. It will not work. No matter how many times they try, all they will do is destroy the currency and destroy the economy in the process. Anyway, hopefully they will come to their senses before it's too late. In the meantime, we need to understand what's going on, and gold is telling you what's going on. The dollar is telling you, so we have to stick with our program. Anyway, on that note, have a great weekend, everybody. In case you happen to watch this in time, I will be on CNBC Cuddle and Company tonight at 7 o'clock.